Legendary investor Jeremy Grantham, who is famous for predicting the 1989 Japanese bubble, the 2000 dot-com bubble, and the 2008 housing bubble, just dropped a massive bombshell on one of the most shocking crises of all time. He is claiming that there is more pain to come and the collapse will be quick and painful, and it's going to be everyone's fault for not watching on. And even though the signs have been there for years, investors will have a rude awakening. You see, everyone knows that the government messed up and the Federal Reserve printed $5 trillion, and this led prices to rise, and inflation is up to 8.3% as a result of this. But Jeremy claims that the US markets are in a bubble so large that when it bursts, it would damage more than $45 trillion in assets in the US alone. He's been warning about this for about a year, and he now says we're on the verge of that last explosion that will result in the next market disaster. So let's look at what a super bubble is and why he believes we're in the middle of one. But before we go over that, let's take a look at what Grantham had to say about this prediction of the market crash last year.
If you're looking for the very early warning signs of a bubble breaking, you find the stocks that have done the best, SPACs and particular SPACs and Tesla and Bitcoin. And you wait until they start to have these big daily drops, and then they recover and they drop and they recover. And that's the very early warning. And the market in 2000, for example, didn't go together. They took out the pet.coms and shot them. The rest of the market continued to go up. It didn't even deign to notice the shooting of those little guys. They were only worth scores of millions or a couple of $100 million. Then they took out the junior growth stocks and shot them, and the market kept going up. And then they took the medium growth stocks and shot them. And finally, by the summer, they were shooting the Ciscos. And the entire tech part of the market had been shot. And that had been 30% at the market peak of the total market cap. And yet, the S&P by September was at the co-equal high of March, which meant that the other 70 had continued to rise. So that is a typical way. Bubbles don't necessarily break en masse, but having sliced off the tech and the dot-coms, then finally the 70%, like a giant iceberg, rolled over en masse, the 70%, and went down for 2.5 years by 50%.
So what Grantham is saying is that the fall comes in stages, not all at once, and that the stock market recovers immediately afterwards, as we saw in 2020. However, a valid crash, such as the end of a cycle crash, happens in increments. The hypermanic names, the tiny capital sort of names, crash first. The meme names come next, then there are the medium caps, the companies that rose much too quickly, followed by other cyclical areas of the markets, such as chips, and large tech companies crash as the final blocks are generally the top names. So what even is a super bubble? Well, a normal market bubble is an event in which assets are priced at 2 sigma deviations from the historical trend. A super bubble is instead when assets are priced at 3 sigma, the standard deviation from the historical trend. In essence, if a bubble happens when prices are a little too high, a super bubble happens when asset values deviate significantly from historical valuations for no reason at all. And according to Grantham, recent market movements indicate that the market is ready to implode. When questioned about the performance of US stocks since the start of the year, in an interview he said, "This is very rare. The same happened in 1929, it happened in 1972 before the very big decline then. It happened in 2000 before the tech wipeout." Another relevant metric is the entire allocation to equities versus other assets. You see, people buy more and more stocks when the market rises. When stocks are high, individuals tend to put more money into stocks because stocks can only go higher. This is the market's prevalent belief. This is also not a good indicator, owing to the fact that over-allocation indicates excessive market confidence. Now, the last blocks to fall could be the apples of the stock market, because once the institutions lose faith in Apple, that's when the grand finale happens. We're also talking about the mom-and-pop retail investors who have been investing in Apple for years. And once they capitulate and start dumping Apple stock, then we see the mother of all shorts and the mother of all crashes.
The S&P 500 peaked at almost 4,800 points. Where does it bottom?
The trend line
being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
He said to prepare for an epic finale, and he warned that this will be a tragedy when the super bubble finally burst. And it's already bursting before our eyes. Now, Grantham also said that the economic data inevitably lacks major turning points in the economy. He also added, to make matters worse, at the turn of events like 2000 and 2007 data series, like corporate profits and employment, can subsequently be massively revised downwards. He also said that during the last leg, or this leg, that the bear market rally typically happens now, and the current super bubble appears to have paused between the third and final act, according to Grantham. Now, when Grantham talks about the final act and the epic finale, he means what happened before the stock market during the crash of 1929, the Great Depression, in the early 70s, the dot-com collapse, in 2000, and the financial crisis of 2008. He's essentially saying that things like these come in threes, or have three bounces. Number one is the complacency stage before the panic bounce. Number two, the anxiety stage bounce. Number three is the denial stage bounce, which market participants are left holding the bag and believe their investments will come right back up. And this is what we saw in the so-called summer rally, the so-called June bottom. But then what happens? The answer is the epic finale, which is the panic stage, when everybody panics and says, you know what? Everyone's dumping their bag, I gotta get out when the capitulation happens. And that's when we get that grand finale, the massive crash that Grantham is predicting. But the stock market is not the only thing that is being called a super bubble by Grantham, because the super bubble is also tied to everything else. For example, housing prices are also skyrocketing. So how is that market doing? Well, the basic issue with asset values increasing so quickly is that we will have to pay the price when they ultimately come back down to being stable. The house prices to income ratio is also on a very similar trend. The current value is sitting at around 7.5, but the historical average is closer to 5. Now, if these were to go back to previous levels, then the housing market alone would lose 30% of its total value alone, which could result in the loss of $15 trillion of wealth. Now, traditional investment assets have also risen in price. I mean, look at how much food has risen all around the world, in Europe and in the US. Now, Grantham also believes that if this negative wealth and income effect is worsened by inflationary pressures in other sectors, we would face major economic problems. Now, if that happens, not only will stock portfolios suffer, but so will salaries, pension funds, and government deficits. And finally, as a potential catalyst for this bubble to explode, he's pointing out that the Fed may hike interest rates way faster and sooner than predicted, triggering a domino effect in the housing market. Now, they may not want to do so on purpose, but they may be forced to do so as a result of uncontrolled inflation. Interest rates, as seen in this graph, are also much above their mean value. And I also made a video on how deflation could be a lot worse than inflation, so be sure to check that out. Now, furthermore, if borrowing rates double from present levels, housing will not be the only sector affected. This might spread to other assets, such as unproductive tech businesses. But unfortunately for everyone, Grantham claims that the bubble is still a huge possibility. I mean, he's already correct right now. His interview I showed was from a very recent interview a couple months ago, before inflation rose to all-time highs and equities began to fall. But everyone is concerned that the market is going to fall, yet nobody questioned their decisions when property prices or stock prices were rising by 50% every year. The Fed continued to print money, and politicians bragged about their accomplishments. Now, I want you to tell me in the comments down below, do you believe that we are going to see one more final crash? Let me know your thoughts down below. And if you enjoyed this video, then please be sure to like and subscribe for more content. Until next time.